Hello there, MSL here and welcome to this summary video on IAS 23 borrowing costs, which requires that borrowing costs directly attributable to the acquisition, construction or production of a qualifying asset should be included in the cost of the asset, with other borrowing costs being recognized as an expense. So quick recap, where have we started from and where are we today? So IAS 23 started all the way in 1982, November, with subsequent issuance of standards, exposure draft, a standard, another exposure draft, and then the final version of IAS 23 that we have, which was issued in 2007. So as a standard, IAS 23 borrowing cost was reissued in March 2007, and it applies to annual reporting periods beginning on or after 1st January 2009. So now that we know this, what is the objective of IAS 23? Why was this standard issued in the first place? The objective of IAS 23 is to prescribe the accounting treatment for borrowing costs. And here, borrowing costs include interest on bank overdrafts and borrowings, finance charges on finance leases that will be accounted for under IFRS 16 leases, and any exchange differences on foreign currency borrowings where these are regarded as an adjustment to interest costs. So we know the objective of IAS 23 now, what is within the scope of IAS 23 borrowing cost, and what is outside the scope of IAS 23 borrowing cost. So in general, there are two types of assets that would otherwise be qualifying assets, but for the purposes of IAS 23, they are excluded from the scope of coverage of the standard. The first would be qualifying assets that are measured at fair value, such as biological assets accounted for under IAS 41, agriculture. The next out of scope item will be inventories that are manufactured or otherwise produced in large quantities on a repetitive basis and that take a substantial period of time to get ready for sale. An example of this will be maturing whiskey. So now that we've got the scope covered, let's look at the accounting treatment, or when it comes to recognition to be specific. IAS 23 borrowing cost provides that borrowing costs that are directly attributable to the acquisition, the construction, or the production of a qualifying asset should form part of the cost of the asset and therefore should be capitalized as part of the cost of the asset on the statement of financial position. All other borrowing costs are to be recognized as an expense in profit or loss. What does this mean in practical sense? It means that if you incur any borrowing costs that are deemed to be qualifying costs and they relate to the acquisition or your construction or production of any qualifying asset, then as part of the cost of the asset that will be placed or capitalized on the statement of financial position, you need to also add up or include these borrowing costs instead of expensing them. Now, borrowing costs that do not qualify will clearly be treated like any other borrowing cost and would ordinarily be expensed in profit or loss. But we've spoken about qualifying asset. How does IAS 23 define a qualifying asset? The standard is clear. A qualifying asset is any asset that takes a substantial period of time to get ready for its intended use or sale. So this could be any property, plant, or equipment that will be under IAS 16, or any investment property that will be under IAS 40 during the construction period. This could be any intangible assets during including IAS 38 intangible assets during the development period, or any made to order inventories that will be under IAS 2 inventory. So if you have any type of asset that takes a long time or a substantial period of time to get ready for its intended purpose, its intended use, its intended sale, as long as you've met the substantial period of time criteria, that will be a qualifying asset, and any borrowing cost incurred with respect to those assets could qualify for capitalization as part of the cost of the asset. Let's look at some specific measurement rules when it comes to IAS 23 borrowing cost. So where funds are borrowed specifically, then costs eligible for capitalization are the actual cost incurred, less any income earned on the temporary investment of such borrowings. What does this mean? It means that if you go for a specific loan, you have just one loan balance, and the purpose of that loan was to either acquire, construct, or produce or make your own qualifying assets, which you've defined as any asset that takes a substantial period of time to get ready for its intended use or sale. Then that particular loan, the amount of borrowing costs capitalized will be the actual cost incurred, the actual interest cost incurred. And then if you were able to generate any interest income within a certain period, you deduct this interest income earned from the cost and then you capitalize the difference. So let's say you went for a loan for a year, but for 2 months you were able to quickly turn around the money and get some return on investment. That interest income will be deducted from the cost, and then the difference is what will be capitalized as borrowing cost. So take note, actual cost less any income earned on the temporary investment of the funds. What if the funds are part of a general pool of borrowing? So where the funds are part of a general pool, then the eligible amount to be capitalized is determined by applying a capitalization rate to the expenditure on that asset. This capitalization rate will be the weighted average of the borrowing cost applicable to the general pool. So if you have one loan or more than one loan, two loans, three loans, four loans, any amount of loans, then in that case, the weighted average interest rate of all the pool of loans is what you use to compute the borrowing cost to be capitalized as part of the cost of the asset. Now to some more specific capitalization or measurement rules. In general, capitalization of borrowing costs should commence when expenditures are being incurred. Capitalization of borrowing costs should also commence when borrowing costs are being incurred, and also when activities that are necessary to prepare the asset for its intended use or sale are in progress. Take note that this may include some activities prior to commencement of physical production. So here, essentially, you need to commence capitalization of borrowing costs. Take note, it must be on a qualifying asset. As long as expenditures are being incurred, borrowing costs are being incurred, and activities that are necessary to prepare the asset for its intended use or sale are in progress. Now, when should you suspend capitalization? So, capitalization should be suspended during periods in which active development is interrupted. An example of this will be where, for example, because of a natural disaster, let's say a flood, you are unable to continue construction of your qualifying assets. Within that period, you are required to pause or suspend capitalization because active development is not ongoing, and as such, you are not incurring eligible borrowing costs. Let's say during COVID-19, if because of the pandemic, you had to cease development, you had to cease construction of that qualifying asset, then within the period that you cease construction or development of the qualifying asset, you cease capitalization. You do not add capitalization cost or borrowing cost to the cost of the asset. Take note, this is a temporary stoppage. It's a pause, but you can resume after things get back to normal. When should you actually cease or stop capitalization entirely? Capitalization should cease when substantially all of the activities necessary to prepare the asset for its intended use or sale are complete. Take note here that IAS 23 uses here the term substantially. So you shouldn't necessarily have done everything, but you should have done a substantial portion. So here, the rule is that if only minor modifications are outstanding, then this indicates that substantially all the activities are complete. So if it's a project and every major activity that needs to be done before the project can be used or launched, and all of these have been completed, then we can say that indeed all substantial activities have been completed and you have to cease borrowing costs. So this has some level of subjectivity, and obviously entities are required to apply their judgment. But take note, the rule is that you cease capitalization as long as substantially all of the activities that are necessary to prepare the asset for their intended use or sale are completed. What are the rules when construction is completed in stages? So where construction is completed in stages, which can be used while construction of the other part continues, then capitalization of borrowing costs should cease when substantially all the activities necessary to prepare that particular part for its intended use or sale are complete. What does this mean? If you are into a project that is into phases, so there's phase 1, there's phase 2, and phase 3. If phase 1 is completed and you can begin to use phase 1 whilst phase 2, 3, and the remaining phases are still under construction, then IAS 23 is clear. You need to cease capitalization on the completed part, in this example phase 1, as long as you can say or prove that substantially all of the activities necessary to prepare phase 1 or that particular part for its intended use or sale are completed. So these are the rules around construction in stages. So when it comes to disclosure requirements under IAS 23, what are the specific rules? There aren't too many requirements when it comes to disclosures, and the key ones to disclose will be the amount of borrowing costs capitalized during the period and then any capitalization rate you used. So this has been a summary video of IAS 23 borrowing costs. If you love this video, don't forget to smash that like button and don't forget to share this video within your entire network. I will catch you in the next summary video.